Good morning and welcome to the Pan African Resources PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time by the Q&A tab situated in the right corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it received in the meeting itself, but the company can review the questions submitted today and publish responses where it's appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to CEO Cobus Lutz. Good morning to you, sir.
Good morning, and thank you to all for your time in joining us today. We're going to run through the results presentation and then after open for questions. Just disclaimers on slides 2 and 3. Health and safety, which is obviously key when you are operating in the mining space like we are. We have a sector-leading safety record as Pan-African, and I think what a standout highlight in the year that's passed is all of our surface operations in South Africa and Australia ran without one single lost time or reportable injury. The underground operations in South Africa were less fortunate, and we had a couple of incidents and very tragic fatal accidents. And we're working very hard towards ensuring that those do not recur. We do believe that in the years ahead we can get to a position where we have very limited or certainly our aim is to have a zero harm working environment and to have all of our people return home safely at the end of every day. Group overview, investment highlights, Pan-African diversified portfolio now of surface remining and underground assets. We did up just under 200,000 ounces of gold from two major mining jurisdictions being South Africa and Australia. This established production of the 200,000 ounces is underpinned by high margin operating mines, generating very strong cash flows, certainly in this gold price environment. We're one of the very few gold producers that are able to grow as significantly or materially as we are in the next year. We forecast a minimum of 275,000 ounces of production for the next financial year, which is an increase of almost 40%, which I think is very attractive. We have long life assets with a very big reserve base in terms of gold in the ground, proven track record in terms of delivery and sector leading dividends that we can discuss a bit later. Experienced management team. We've been around for many years in terms of running this business and building it to what it is today. And then just the existing asset base also gives us the ability to leverage for further production growth and earnings growth into the future. So I think that's quite exciting. Sorry, I'm just sort of trying to get to the next slide here, which is the slide number 9. Share price has done very well, obviously over the last years. I remember buying my first stock in Pan-African in 2009 in South Africa in terms 45 cents, and currently the share price is circa 18 rand or in the middle 70s in terms of P. So it's been a great return for shareholders, and that excludes the sector leading dividend that we pretty much paid throughout. I think that further enhances the returns. A good base in terms of shareholders in South Africa, the UK, and elsewhere. And I think the fact that we're moving to the main board or intending the move to the main board of the LSE will take us and expose us to other shareholders, a deeper pool of investors, and then we would quite likely also attract index funds in terms of investment. So that's a further catalyst in the months ahead. Group overview on slide number 10. It's a pretty unique portfolio of assets where we have 3 large asset complexes in South Africa. Both other than MTR, all these assets have underground components and then the surface. MTR is exclusively surface remining, and then Australia also a combination of surface and underground. Just gonna trying to get to my next slide here. Apologies. It seems to be a bit of a delay in terms of the slide deck. Slide 12, just an operational snapshot of our key assets, which we will go into detail on some of the further slides. But importantly, is going forward, about 60% of our production will be sourced from surface, and that's gives us lower cost assets, more predictability, and less volatility in terms of production. So 60 odd percent of our production now comes from surface, and circa 80% or more of our margin. So I think that's been a very good repositioning of the group in the past years. Our operating environment in South Africa and Australia, Barberton Mines is a track record of more than 140 years of operating successfully in South Africa. And we say that, I mean, we go to great lengths to make ourselves less susceptible to issues as far as South Africa is concerned. We were the first miner to commission large-scale solar. We'll talk a little bit about our renewable energy initiatives in the next slides. All of our mining rights in South Africa are long dated, so there's no issue with mining rights. Despite some of the negative perceptions around the jurisdiction in South Africa, it has a long track record in terms of successful underground and surface mining, and it has a well-established legal regulatory framework and everything else. It's been quite stable, and even from an Eskom perspective, our electricity utility, we've now seen almost 10 months without any load shedding. So that's also assisted us. Stakeholder engagement, our social license to operate is very important for Pan African, and we go to great lengths to make sure that we have good relationships with our employees, unions, all of the communities surrounding our mines. We make a meaningful, positive difference in all these areas that we operate. We've never had protracted labor issues at any of our operations, and for the most part, we have multi-year wage agreements in place. And security is key for us when you're dealing in such a high-value commodity such as gold. And we have an excellent team that makes sure that we can continue to operate and that security is taken care of. If we then proceed to key features for the year that has passed, FY25, so our year end is June. Production was up by some 6%, and that was on the back of MTR producing, and then also very limited production from Australia. So Australia will come into its own in the year that's a year ahead. Importantly, in the second half of the financial year, we achieved record gold production with these assets producing. And as I've said, we're one of the few producers that can actually expand production so materially in the year ahead. So our guidance is 275,000 ounces or more in the next year. That's an increase of 40 odd percent. Group all-in sustaining costs were up. There's been big cost pressures generally in the industry. I think there is a slide on costs a bit later in the deck. But for us also, the underground mines increased the unit costs in the year that's passed. We are guiding that costs will come down in FY26, and we are very competitive when we compare ourselves to the rest of the global sector in terms of our all-in sustaining costs. And then obviously the gold price and also increased production assisted us in terms of the set of financial results that we delivered for the year that's passed. Really nice increase in profits, cash flows, very strong balance sheet, and we'll talk about the de-gearing and dividends and everything else in some of the next slides. So all in all, it was a positive year. We did still have a hedge that was outstanding that for the most part we used to fund the construction of MTR. That cost us, in terms of opportunity cost, some $30 odd million. So importantly, we are, as of the 1st of July, we are entirely unhedged. So investors have full exposure to the gold price going forward. Slide 16, our margins. I mean, it tells a very good story in terms of expanding margins. That's on the back of obviously excellent gold prices, but also the focus on lower cost, higher margin assets, and then the increasing production base. So then just slide 18, tailings retreatment, which has become sort of the cornerstone business or flagship business for Pan African. great track record in terms of commissioning these plants all the way from 2013. You can see we've delivered on budget, on schedule. So this has been a great success for us. The most recent two operations, MTR and Tennant Mines, delivered in the last year. And again, it's not many operations or companies that can deliver two new flagship projects in 1 year, and that's really what we've done in FY25. And at the bottom of the slide, also an increase in production profile in terms of tailings and surface sources in the next years. If we then go on to just the performance per operation, and we can start with the BTRP. Let me just check this. Let's start with Elikhulu on slide 19. This was a great success for us. We commissioned in 2018. We still have 9 years of life remaining, producing circa 50,000 ounces of gold a year at a very exceptional margin. All-in sustaining costs were sub $1,100 in the year that's passed. So this really is a great asset for us and will continue for many more years. The BTRP at Barberton, we managed to extend the life of this with our first gold tailings operation we commissioned in 2013. And when we initially commissioned BTRP, it was only scheduled to run to 2021. As I've said, we've now, in addition to having operated it until the sort of end of this last financial year, we've extended the life by another 6 years. All of the capex that we need to spend for this life extension will be done in pretty much the next month or so. It's not a huge number. The all-in sustaining cost for BTRP is excellent. It's the lowest cost producer in the group. Going forward, we expect an increase in the costs as we now again retreat what we call the Bramber tailings facility. So this is the second time that we're retreating these tailings. It's been a really good and excellent success story for us. And even after the 6 years, there's a long life ahead for the BTRP. So we have assets that are underground that we would look to access and mine in a mechanized fashion, principally Royal Sheba. It's just up to now has been too low grade for Barberton, about 3 grams per ton. But these are large ore bodies. They extend as far down as we'd care to look for them. So there's a long life ahead of the BTRP after we have finished in terms of treating tailings. Then excitingly, MTR on slide 21. Just to recap, we bought all of this off a liquidator for a total of about $2 an ounce in reserve when we were done with our studies. So it's been a great success for Pan African. We went and built all of this plant and infrastructure in 14 months. Total capital was about $130 million. At the current gold price, we estimate we will make all of this back in circa 2 years. So this is excellent. MTR currently does about 50,000 ounces a year. We're busy with an expansion project that'll be done early in calendar 2026. That's going to expand the MTR operation to about 60,000 ounces per year and also bring down costs. In the last year, unit costs were slightly elevated just because of startup costs and a couple of other items, but we expect costs to settle to below $1,200 all-in sustaining, which really means that this is a world-class asset in terms of the margins. And we can be producing here for many years, as we'll discuss on slide 22. So we have more than 200 million tons of tailings sitting on surface. These are just the tailings we currently own. And obviously, the life then of MTR as a base case would be circa 20 years. We are busy with a feasibility study to look to potentially construct another facility to treat some of what we call the Soweto cluster. If that did proceed, then it would pretty much double production from this part of the world for Pan African. So there's very significant growth that we have as part of our portfolio. We potentially might not do the big bang, i.e., like a completely new plant, but we, as a second option, could look to further expand MTR. What would that look like? That would probably be sort of a 1.3, 1.4 million ton per month operation versus currently a million, producing some 70, 75,000 ounces, and you could do that quite successfully for 15 years or so. And I think also, interestingly, there are other tailings in this area that we do not yet own. Without the infrastructure and the team like we have at Pan African, these facilities are generally only a liability. So it is quite possible that through the life we could look to consolidate even more tailings in this area and further grow the operation. And then just one slide on just the environmental and socio-economic benefits of this project. The area where we commissioned MTR was very difficult from an illegal mining perspective, a pollution perspective. And the beauty with what we're doing here is we're effectively treating these tailings, reducing liabilities. We often say that we are turning legacy liabilities into profits. At the end of the life, there will be pretty much no liabilities of any size remaining. Improved water quality, land would be freed up for other development and other uses. So it's a win-win for all legitimate stakeholders, these sort of operations that we run as Pan African. So it's great to be involved in assets like these. Then slide 25, Tennant Mines, which is also a plant that we commissioned in the last year, on schedule, on budget. We were very fortunate to actually secure this asset. Took us about a year in terms of due diligence before we got comfortable with what we were buying. Ultimately, we went and paid less than 6% of our market cap at the time when we concluded the deal, which was December of last year. And we have a huge asset base. The plant that we've commissioned here at Tennant is 3 times the size of anything that's ever operated in this gold field. It's a major historical province, the highest grading gold field in Australia, in a tier 1 jurisdiction, the Northern Territory. So for many years, the Northern Territory was not really open to new mines, a difficult royalty regime. All of that's changed. We find the government very supportive, and we look forward to expanding our business in that part of the world. As we've said, we've started production, and we're guiding 40, 60, 50,000 ounces in the year ahead. We have a dominant land position in that part of the world. We have retained our very experienced in-country Australian team. They're running the assets. The area is underexplored, certainly. I think very limited drilling below 150 meters, and very attractive economics and a long life of mine that we also have as part of this project. Just a schematic on slide 26 of what it looks like. As I say, it will follow a hub and spoke strategy, with this plant that we've commissioned being 3 times larger than anything that's operated in this gold field. And then the mining, for the next 3 years or so, we expect to do about 50,000 ounces of gold a year. There's definitely scope for us to increase production from this gold field. Also, there's on slide 29 just a picture of what our plant at Nobles look like. And then just sort of very briefly, sorry, to take one step back, on slide 28, we are increasing mineral resources and reserves through modern exploration techniques and studies. And I mean, we're finding that this field is very prospective. Limited drilling we've done. I mean, there's an asset, Warrego, that we've acquired as part of the portfolio. Limited drilling, again, as I've said, not yet upgraded the resource and reserves, but some of the grades we find 5 grams per ton gold, and then anywhere from 2 to 10% copper. So at the moment, we focused on gold as far as Tennant is concerned, but definitely scope in the next years to look to build Warrego, which will be a copper gold asset. If we then proceed to our underground mines, slide 31, the Evander underground. This was a disappointing year for Evander in terms of production. We were behind in terms of commissioning the new infrastructure. So we constructed and designed a sub-vertical shaft for hoisting, and that construction took quite a bit longer than what we had hoped and anticipated. All of it is done now, and we reached steady state in April, so we now have proper hoisting capacity. There's nothing wrong with the Evander ore body. It's one of the largest undeveloped ore bodies in the world, and we will, over time, bring this ore body to account. So we're quite comfortable in guiding very substantial increase in production from the Evander underground in the year ahead. Base case going forward, 65,000 ounces a year, with all of the money that now been invested in terms of optimizing the infrastructure. Fairview mine at Barberton, as I've said in the introduction, 140 years of mining, still discovering new ore bodies. We get the bulk of our ore from the MRC ore body at Fairview, and long life, 23 years of life remaining at Fairview. And clearly, the Barberton complex at this gold price is generating very attractive cash flows for the group. Just very finally on underground, on slide 33, Consort Mine turned a corner in the last year. We almost doubled production, and we're quite comfortable that we can maintain production at these levels. That also means that Consort is now cash flow positive. We generated some 50 million rand of free cash in the last year, so that's a big turnaround for Consort. Sheba also positively, we've restructured, we cut costs in terms of employees, so you can expect a better performance from Sheba Mine in the year ahead. Group overview in terms of all-in sustaining costs, slide 35. 85% of our portfolio produced at an all-in sustaining cost of $14.25 per ounce. Very attractive, world-class, we like to think. The higher cost businesses at Sheba and Consort, as we've said, there are plans, so you should see those costs come down further in the year ahead. Slide 36, that just compares Pan-African to the rest of the global sector. As we've said, South African mines, for the most part, are known to be high cost. Not the case with Pan-African. We compare very favorably with the rest of the global gold sector. Capital projects on slide 38. So this is the last year that we in FY26 will be spending this amount of capital. And I think we need to emphasize that we're bringing forward some capital spend just to give ourselves a bit more flexibility and also to further expand operations. So obviously, Tennant Creek, there's a bit of capital. This is in terms of bringing the asset to account. At MTR, as we mentioned in previous slides, we are expanding production from 50 to 60,000 ounces per year. That expansion will be done January, February. At Elikhulu, we're also bringing forward the construction of a new pump station at what we call the last tailings facility that we will be treating for the remaining 8 to 9 years of life. So bringing forward this capital will give us a bit more flexibility, and certainly in this gold price environment and with the cash flows we're generating, it makes sense to spend some of the capital now. So Pan-African has been investing in our portfolio of assets through the cycle, and I mean we're very much able to continue to spend capital and return cash to shareholders in the form of dividends, buybacks, plus then de-gear the balance sheet, as we will speak to in some of the next slides. ESG, as we've said, we make a meaningful difference meaningful positive difference in the areas where we operate. We build schools, clinics. We've spoken about our plans in terms of renewable energy and water. We're expanding our water retreatment capabilities, and we'll look to use very limited potable water in the group going forward. Governance and compliance, very much focused on ensuring that we're compliant. And I mean, we are currently dual primary listed on the Johannesburg Stock Exchange and London. And going forward, as we said, we will look to access or move our London listing to the main market, and certainly before the end of December of this year. Just to conclude on renewables on slide 41, it's been a great journey for us. It makes sense from an economic return perspective. Also, it reduces our emissions, and it's quite possible. I mean, our aim would be in the next years to be 50% or more renewables based, and it's quite possible for us. We're different to sort of the miners that use huge fleets of yellow equipment. In South Africa, we're mostly reliant on electricity, so there's a lot of scope for us to expand renewables as we've been doing in the last years. Won't talk too much about financials on slide 43, but as we've said, it was an excellent year that's passed, and we can expect a much better year going forward. We are unhedged, our production going up, as we've said, by circa 40%, and we're bringing down the unit cost of production. Our guidance in terms of all-in sustaining cost is 1525 to 1575, so it's lower than where we've been for the last year. That also means on slide 44 that we are able to de-gear we forecast that despite all the capital we've spent, despite the really nice, attractive increase in dividends, we should still be ungeared or de-geared from a net debt perspective before the end of FY26. It really is a good position for us to be in. And then we've spoken about dividends, and we aim to continue to give our shareholders a sector-leading return in terms of dividends, and we are increasing the US dollar dividend forecast that we are proposing at the upcoming AGM by almost 80% in a year, and that AGM is beginning of December, and dividend should then be paid in sometime in December. So it really is a very attractive cash return to shareholders. We also are continuing the buyback program that we announced before year end. And then just to conclude on FY26, it's really will be, in our assessment, a year of growth delivered. Capital's been spent, the investments have been made, and now it's time in this excellent gold price environment to reap some of these benefits. So we'll continue to focus health and safety and make sure we meet our production and cost guidance, execute on capital projects, obviously continue our focus on ESG, renewables, recycling of water, and then maintain our focus on generating sustainable shareholder returns as we've done for many years. And growth is also something that's not off the table despite what we've done in the last years, but we will be very circumspect, very conservative as far as growth is concerned, as we have been in the past years. That's a brief overview, and thank you again for your time this morning. I suggest we then move on to questions if you're happy for us to do so.
Yeah, that's great. Well, Cobus, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions. You can do so just by using the Q&A tab that's situated on the top right corner of your screen. But just while Cobus takes a few moments to read the questions that have been submitted today, I'd like to remind you that the recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we have received a number of questions, both pre-submitted and throughout today's live presentation. And Cobus, I'll hand back to you at this point to run through those, and I'll pick up from you at the end.
Thank you very much. So let's go to the question. The first question: MTR and Tennant have been great acquisitions, and execution has been excellent. Can you outline your growth and any diversification plans? Specifically, are you considering opportunities in other jurisdictions or commodities such as copper? Africa has many quality assets available at low prices, but often lacking capital or effective management. Given your strong cash flows, how do you view such opportunities, and are you actively assessing acquisitions? I mean, we always look at or looking for opportunities, but the beauty with Pan African and our business and our positioning now is that our assets are long life. We don't have to go and buy anything at expense of multiples at this point to grow production like we have that we forecast we will do, about 40%, as we've said, in the next year. That's very attractive by itself. Africa is challenging, or a lot of Africa at this point is challenging. West Africa is a number of jurisdictions that are quite unstable. We just don't see the need for us to go there at this point. We have more than enough to do in South Africa in terms of tailings, building, expanding that business, and then obviously also Australia, where we now have a great beachhead, and in terms of Tennant, and we will lots of exciting growth just in our own portfolio in Australia. So we never say no to looking at opportunities, or every time we assess an opportunity, also learn a little bit more about our own portfolio and what we can do. But we're in a great position, and there's no need for us to do anything. I think our track record in terms of acquisitions also show that we are always incredibly disciplined as far as that's concerned. In terms of other commodities, I spoke about Warrego, which is copper gold. So if there's one other commodity, it would be a copper gold sort of play, and we look forward to getting a feasibility out on Warrego and then taking it from there. The next question was, is consensus forecast revenue and profit appears still to be very low, for FY26. What gold price is being used for this? And indeed, despite revenue and profit set to grow in 27, EPS forecast is slightly lower. Is there a specific reason? Yeah, it's an interesting one. I do think analysts have been lagging in terms of the gold price. In terms of our planning and budgets, we budget at a much lower gold price than what is currently being received. But I mean, we do get the comment that from investors that sort of analysts need to relook at the gold price, and that really is their call, not ours. But I mean, we have a very strong position as far as earnings and cash flows are concerned. And FY27, there should be no reason for earnings to go down. I think it might have just been quite some way off. But yeah, I mean, we do see continued earning growth in this gold price environment. Then, what's the company's capital allocation policy? What is the policy for dividends? So, I mean, our policy for dividends is basically 40 to 50% payout of discretionary cash flows after allowing for contractual debt repayments and other one-off items. As we've said, we're quite proud of our dividend track record, and then also the fact that we are able to pay a sector-leading dividend. In terms of capital allocation, it's an interesting one. I mean, it's a balance between returning cash to shareholders in the form of dividends, limited buybacks. Shareholders either like or hate buybacks. We think occasionally it does make sense, and that's why we continue to buy back some of our stock. In terms of other capital priorities, the first priority is reinvesting in our business. Then we look also at growth, and again, we've managed to successfully balance all of these requirements. And the beauty of the current gold price environment is that, it's not an issue for us to be able to meet all of the requirements as far as capital allocation is concerned. Next question is, a Tennant JV partner has reported excellent and increasing results at White Devil. Recent scoping study presented possibility of a large 60,000 ounces production. If results continue positively, we'll perhaps need to expand Noble's plant. I think it's very encouraging. White Devil is one of the options we have as far as Nobles is concerned. One of the concerns around the Tennant Goldfield in the past has been that there are a few deposits of scale, the likes of Warrego and White Devil demonstrate we can find large deposits. So, I mean, it's very exciting for us. And there is scope to expand the Tennant plant, most definitely. Also, next question, also at Tennant, given market conditions and our financial strength, is there potential for the Warrego project to be accelerated? So, I mean, our big focus is being commission the plant, which we've done successfully, and now we're looking to optimize this business. But as we said, very exciting prospects for us as far as Tennant in Australia is concerned. Then the next question, if the approval is given for standalone development for the MTR Soweto cluster, what would be the approximate timeline to production? We could probably fast track sort of 24 months or so to production. I think our base case for our business in terms of MTR is not to go and spend huge capital on a new plant, but clearly let's wait for the feasibility study to be complete. But I think ideally we might want to do sort of more conservative growth, potentially sort of, as we've said, expand the MTR operation from about a million tons a month to 1.3, 1.4. That's going to increase our production to 75,000 ounces high level for many years. And it's quite an attractive position for us to be in. And then question again, Evander, a lot of development money has been spent and it's shown to continuing in the next fiscal year. The positive results are now being seen from 24 to 25 level. What is happening with the level 7 Egoli project? This has previously been presented as increasing production by up to 60,000 ounces. Is it still the case? Egoli is very much still there. We've been also very focused on just making sure that the existing 8 shaft business operates like it's supposed to, and that will be the focus in the next year. Egoli is an attractive project, but given just our capital priorities, it's not something we're going to be pursuing in the next year. We've successfully repositioned the business. The underground continues to be important, but surface and tailings is really where our focus is at this point, given the margins and the stability of these assets. So that's probably where we're going to be growing in the next couple of years. And there's a question, when do you expect listing on the main LSE market? So we've guided that we should have the process done before the end of December of this year. Our teams are working very hard to make sure we tick all the boxes. What capital has been allocated to exploration in Australia? I think the total capital budget for Australia is about 30 million US in the next years. In the next year, that includes developing open pit, starting to develop the Juno underground, and then exploration. Yeah, as we said, very exciting. Just our finds in Australia. And there's a question: can you give some flavour as to the overall quantity of satellite tailings that aren't currently owned by PAF? It's difficult to quantify, but there are some very substantial tailings around. Yeah, it's in our base case, there's no need for us to go and buy other tailings, 200 million tons with Mogale and Soweto. It goes a long way. Even with an expanded operation, you could be producing for some 15 years. But we're always looking for new opportunities. Question is, do you envisage in the future, given the growth of the business, an interim and a final dividend? It's something we'll look at, but I think the message is overall, we have a very attractive dividend. The board will reassess the merits of an interim at the half-year results. But the point again is that I think sort of the dividend has grown by some 80% in the last year, so shareholders should be quite happy with that. I think that brings us to the end of our Q&A. If there's nothing else, then we can conclude, and thank you again for your time this morning.
That's great. Well, Cobus, thank you very much for updating investors today. Could I please ask investors not to close the session, as now we automatically redirect to provide your feedback, and all the management team can better understand your views and expectations. On behalf of the management team of Pan African Resources PLC, we'd like to thank you for attending today's presentation, and good morning to you all.
Thank you, and we look forward to speaking soon. Have a good day.